Welcome back to our channel. Today, we're breaking down the Bogleheads Guide to the Three-Fund Portfolio, a simple yet highly effective investment strategy based on the principles of legendary investor John C. Bogle. This book provides a roadmap to building wealth while minimizing risk and effort using just 3 funds. If you're looking for a low-cost, easy-to-manage investment strategy, this book is for you. Let's go through the key chapters and insights in detail. Chapter 1, Introduction to the Three-Fund Portfolio. Key concept. The three-fund portfolio is a minimalist investment strategy that consists of a U.S. total stock market index fund, an international stock market index fund, a U.S. total bond market index fund. Why these 3 funds? This combination offers broad diversification, low fees, and simplicity. It provides exposure to the entire global stock and bond markets, spreading risk across thousands of companies and bonds. Chapter 2, Why Index Funds? Key concept. The core of the Bogleheads philosophy is that index funds outperform most actively managed funds over the long term. This is because they track the entire market rather than trying to pick individual winners, leading to lower fees and fewer risks. Benefits of index funds. Low cost, index funds have minimal fees compared to actively managed funds. Simplicity, they are easy to manage and don't require constant monitoring. Market performance, they track the overall performance of the market, avoiding the pitfalls of trying to time the market. Chapter 3, The Power of Simplicity. Key concept. Many investors get caught up in complicated strategies, but the three-fund portfolio proves that simplicity often outperforms complexity. The fewer moving parts, the lower the chances of making costly mistakes. The problem with complexity. Over-diversification, adding too many funds can dilute returns. Higher costs, more funds often mean higher fees and transaction costs. More management, complexity requires more time, effort, and decision-making. Chapter 4, Asset Allocation and Risk Management. Key concept. Asset allocation is key to balancing risk and reward. The three-fund portfolio allows you to customize your risk level by adjusting the proportions of stocks and bonds. Typical allocation example. 60% U.S. and international stocks, 40% U.S., 20% international. 40% bonds. This balance offers growth potential, from stocks, and stability, from bonds. Adjusting for risk, younger investors might lean toward more stocks for higher growth potential, while those closer to retirement might increase the bond portion to preserve wealth. Chapter 5, Rebalancing Your Portfolio. Key concept. Over time, your portfolio may drift from its target allocation as different assets grow at different rates. Rebalancing involves adjusting your portfolio back to the original allocation. How often should you rebalance? Some investors rebalance once a year, while others do so when an asset class deviates by a certain percentage, e.g., more than 5%. Rebalancing helps manage risk by selling high-performing assets and buying underperforming ones. Chapter 6, Tax Efficiency. Key concept. Tax efficiency is critical to maximizing returns. The authors provide guidance on where to hold each type of fund for the best tax outcomes. Key tips. Place tax-efficient funds, like stock index funds, in taxable accounts. Keep bond funds in tax-advantaged accounts like IRAs or 401(k)s to avoid paying high taxes on bond interest. Tax loss harvesting. The book also discusses tax loss harvesting as a way to minimize tax bills by selling losing investments to offset gains. Chapter 7, Why Stay the Course. Key concept. The market will go up and down, but the key to long-term success is staying the course. The three-fund portfolio is designed for long-term investors who can ride out short-term volatility. Common investor mistakes. Panic selling during market downturns. Chasing returns by jumping into trending funds. Trying to time the market. The importance of patience. Stick with your investment plan through good times and bad, as history shows that the market generally trends upward over the long run. Chapter 8, The Psychology of Investing. Key concept. Behavioral finance plays a huge role in investing success. Emotions often lead to poor decision-making, such as panic selling or chasing hot stocks. The three-fund portfolio helps mitigate emotional reactions by simplifying decisions and reducing the temptation to overmanage investments. Key psychological tips. Keep emotions in check. Avoid market noise and sensationalized media reports. Focus on your long-term goals, not short-term market movements. Chapter 9, How to Get Started. Key concept. Getting started with the three-fund portfolio is simple. The book provides a step-by-step guide to selecting the right funds and opening accounts. Steps to start. Choose a brokerage account, e.g., Vanguard, Fidelity, Schwab. Invest in a U.S. Total Stock Market Index Fund, International Stock Market Index Fund, and U.S. Total Bond Market Index Fund. Set your target asset allocation based on your risk tolerance. Automate your investments through regular contributions. Chapter 10, The Importance of Costs. Key concept. Keeping costs low is one of the cornerstones of the three-fund portfolio. High fees can eat into your returns over time, so it's essential to focus on low-cost index funds. How costs affect returns. The lower your investment costs, the more of your returns you get to keep. Even a 1% annual fee can have a significant impact on your returns over decades. Conclusion. The three-fund portfolio is an effective, simple, and low-cost way to invest for the long term. It offers broad diversification with minimal effort and can be adjusted to suit individual risk preferences. By sticking to this strategy, avoiding emotional decisions, and staying patient, investors can achieve solid returns over time without the complexity of more elaborate portfolios. Backhand index pointing right. If you found this summary helpful, make sure to hit that subscribe button and turn on notifications for more simple, easy-to-understand book summaries that can help you grow your wealth and live a better life.